everyone, we're back. It's another True Potential Do More With Your Money podcast. It's episode 168 this week, and we think you deserve 6 of the best. Yes, you heard me right, 6 of the best things that you should know before you retire. That's what's coming up today, and I'm joined in the studio today by 3 of the best. We've got Donald to my left hand side today. Donald's our pension specialist, and over on this side of the desk, Luke's in the house today. Luke's our resident financial advisor, one of many that we have here, of course, at True Potential, and Kevin from the investment management team in the house as well today. Hello, everybody.
Hello.
How's everyone doing?
Very well, thank you.
It's good to see you all again for another podcast. These come around pretty quick, don't they? The weeks fly by.
Every 40 or so, I think I get invited on, so
yes.
I'll book a holiday for the next 40th one.
Good. Let's make it every 60 going forwards, Graham, okay? No, I'm just joking. It's good to have you back, Luke. And today, it's a really important topic, actually, because we get a lot of questions and comments coming in around, bits of advice and tips for people who are coming up to retirement. So today we're going to do it all in one, and over the next half an hour or so, our clients, our advisors, and our viewers, we're going to be hearing us talk around 6 things that they should know before they retire. 6 handy tips. By the end of this podcast, you're going to be absolutely an expert in things that you should know. I want to dive into one then, just first of all, and just as people are perhaps approaching retirement, Luke, is this something that you find that you get a lot of calls, or your team, or a lot of comments or emails coming about this? Is it something as people approach their perhaps mid-50s or so, or that around about 60?
Of course, so when can we retire, or when is the best time to retire, of course. So it's a really good question, Peter, actually, and what you look at is your age, your assets, and where you are in terms of employment. I think, look, a lot of people now tend to retire around about state pension age, 67, but there is a lot of clients who are lucky enough to accumulate the wealth where they can retire earlier at age 55.
Yeah.
I think we need to look at the average life expectancy in the UK is 84 for a male or 87 for a female. You need to make sure that you're well set for retirement. You need to look at the assets that you've got. We can look at the 4% rule. So say if you need something like £20,000 a year, you need a pension pot of at least £500,000 to get that 4% on sort of a sustainable basis. So that's one way of looking at it. Look at your age, look at when your state pensions are going to come in, any other income you've got elsewhere, and really your advisor can look at all of your assets and the best way to take that income, just to make sure that you're set really. If you retire at 55, that could be 40 or 50 years where you need to take an income from your assets. So
you put your finger on it there. You've said 500,000 pot. If you want, that 20,000. We've been doing savings gap, surveys for over 10 years now. Every 3 months we do a survey for the public. Just random people of the public. It's a very representative sample of the United Kingdom. And if you ask people, what figure do you think you'd need to retire, to live comfortably in retirement? This figure of around about 23,000 has always come out of our research. I look at other bits of research done by others, and it's always around about that figure, 20,000, 25, something like that. But to do that, you're going to need a £500,000 pot.
Correct.
I get the impression, perhaps, because again, you look at research and it shows how much people have got in a pension pot, perhaps in their 40s and things like this, as they're getting into those next, looking ahead 20 years, and it's nowhere near that. They're not even on course to that. Do you think there's perhaps a misconception in the UK about how much people actually are going to need? That £500,000 pot seems like an awful lot.
Yeah, it is. Luke did actually touch on that in terms of life expectancy and the 4% rule. Yeah. Most of the reviews and the head count and the reviews we have in the UK is pretty much based on that 4% rule.
Right. And
your average expectancy for everyone in the UK, just the average, obviously different from a male and female, it's 84. Now everyone is living longer in terms of. So if you need a moderate lifestyle, that's it. You need £23,000 really. Yeah. So if you want to draw £23,000 every year from your pot, using that 4% rule, you will need about £580,000 in your pot. Yeah. Now it's different if you just want the minimum lifestyle at retirement. That's different. But what you still need about £13,000. So that's what state pension now is, I think, it's about £10,600. So it's even less than the minimum. Yeah. We're talking about a minimum that gives you pretty much the basics.
Yes.
And nothing at all.
Nothing else. Yeah.
So the moderate lifestyle, what it gives you is you're able to cover all your basics as well. Yeah. But maybe just one ice cream and 2 cones on there. That's it. So that's 23, and that's looking at just single. Yeah. So if you're looking at a couple, that 23,000 per year that takes it to 580,000. You need more. You need about 31,000 pounds if you're a couple. So the research is working in terms of what it needs to do, but it's just the overall picture of the pension, the foundation of pension itself, that we need the totality we need to change in one shape or form.
I don't know about you, but I just talk to people of my age group, and I don't think they would necessarily think it's going to be that figure I'm going to need, and this is how much I've got now, and am I on that track? The beauty, of course, of the True Potential app is you can go in. you can have a look at your pension pot. You can see whether you are on track to achieve that kind of figure, and if you're not, you can impulsive. You can do the things that you're going to need to do to get back on track. So that information is really, really key. So one of those. So let's get into sort of the 6 particular things that we want to talk about. And number 1 is, are you really financially ready to retire? And this goes to this point around: are you on track for that 500,000? And if you're not, what can you do about it? What sort of things can you do?
Yeah, of course. So it's important to meet with your advisor. You can set up a plan in place if you are far away from retirement, where you could potentially make more pension contributions. Look at your overall assets and create really a wealth plan to make sure that you are on track.
Yeah.
Donald mentioned state pensions there, which is really important. So we can do cash flow forecasting, where we can look at other incomes that are going to come into place. You might have an NHS pension, which could be payable from something like age 60.
Yeah.
So if you've got 2 state pensions coming in from age 67 or 68, for some people that's going to be £22,000 a year. That's going to be valuable income, potentially later on in retirement. So it's quite important to maybe bridge that gap before then. Sit with your advisor and just create a plan where you could contribute more to your pension, just to make sure that you've got enough to run up to that and make sure that you have a.
And you want to do that nice and early, well ahead of retirement, because if there is a shortfall, you want the time to be able to fix that. And
of course, you can
do what
benefit from long-term compound investment growth.
Correct.
So the sooner you put it in, the more interest you would get over a longer-term period, over a longer-term investment time frame.
It's a really important point, Kevin, because if you are, perhaps 10 or 15 years away from what you're thinking you're going to be retired. Let's say you're 15, you're thinking about 65, and you're looking at that 500,000 figure or a bit more, as Donald said. The impact of compound growth, about being in the markets, being invested, that pension doing the market doing a lot of the work for you. It's a really important point, isn't it? This compounding effect.
Yeah, I think taking a long-term view,
Yeah.
I think for personal savings can be really difficult, because we can be really influenced by day-to-day movements. And I think I go back to some of the messages that on this forum we put across last year, which is to stay invested, because it was quite difficult, say, this time last year. But had you taken money out, you'd be down in your equity holdings, because equities in the US, the UK, Europe, Japan, they're all up since that difficult period in the spring last year. So staying invested and just holding on to that long-term target is the compound effect.
Yeah.
And Sir David's made this point as well, that just the compound effect from equity growth, it can give you quite a big payoff at the end of it if you can just stay in and keep adding, and your income from equity holdings and fixed interest does build up over time.
And letting the markets, as you say, do that work. Well, I'm going to jump ahead actually to another one of the other things that we talked about, or we were going to talk about a bit later, but it's exactly this point around the 25% lump sum that people can take, because of course at 55 you can do that, but if you're not thinking about retiring till say 65, you may not want to take, and you don't have to take that full 25% in one go at 55. And again, this is something which perhaps people think, I have to take the full thing in one go at say 55 and I can clear some mortgage off, but you don't have to do that. And by leaving more of that invested, that can then benefit from the compound growth you're talking about, Kevin, and get you closer to the number that Luke's mentioned. I mean, tell us a bit about that 25% and how it works.
Well, I mean, where I stand on this is you can take 25%, but you don't necessarily, you can just de-risk it into a lower risk investment. So for instance, if you take someone who's in a balanced profile, you could put it into something more cautious where you will get a lower volatility of returns. Now, last year we just endured a period where obviously those lower risk assets such as bonds were impacted by the inflation shock, and that was a 1 in a 40-year event. But I think you don't necessarily have to take it all out of the market. You can just choose a slightly more cautious risk profile where you will see more of an income effect rather than a price effect, and you'll see a lower risk of return. So you can remain invested, but after speaking with your advisor, choose a slightly different
It's a really good point with the tax-free cash. Look, if you've got a £500,000 portfolio in a pension, the 25% is a sizable amount. If you take that all out at once, then potentially you're going to miss out on investment growth. If you go on to have a 40-year retirement, that's 40 years where some of that could remain invested. But also the way tax-free cash works now is you can use tax-free cash as well as income from your pension to remain a non-taxpayer throughout the earlier years of retirement, where you can spread that tax-free cash out. So I actually spoke to a client that wanted £3,000 a month earlier this week, and you can use tax-free cash and income to draw that slowly month by month and take that in an efficient way.
And Luke is correct in terms of, and Kevin as well. Don't take it away from the wrapper itself, the pension wrapper, because it's the most efficient way of saving.
It's protected in there,
It's protected within that wrapper itself. So once you take it away from the pension, pretty much you've crystallized that that asset.
Yes.
So you've taken it away from a tax efficient zone
Yeah.
and you would definitely would lose money on that one. So
Yeah.
stay invested within that wrapper.
Yeah.
If you want to take the 25%, we're still staying within that hub.
Yeah.
So a more cautious approach,
Yeah.
defensive to cautious,
Yeah.
and just leave it there.
And if you
stay
needed to get
invested.
your hands on some of that money, you could
Ye-
you
yes.
could take say 5% and leave 20 in the market, maybe in a different risk profile as Kevin says, or where it was.
Absolutely,
Is that right?
and I mean, we talked about the 4% rule here. That's pretty much what. If you want to take in terms, but the 4% rule only kicks in, within the first year.
Yes.
What you don't want to do is deplete your port.
Yes.
We are living
Yes.
longer because
Correct.
if you, let's say, if you want to, or you want to retire at 55, and we've talked about the life expectancy age or expectancy ratio is now about 84 now. So you're looking at well over 30 years.
Yeah.
But if you dip over that 4%, we're pretty much if you've got £100,000 pot, dip over that 4%. You're looking at you probably will run out of money within 11 to 12 years,
yeah.
but you still have 30 years to leave.
Correct.
So that's why it's important to stay invested.
Yeah.
When you need it, as and when you require it, you need it. But you have to speak to your financial advisor to actually get the
It's
full
definitely
financial
worth doing
plan
that.
of that, yes, to see whether it works for you or not.
Completely. Okay, good. Right. Well, look, I want to talk about some of the unexpected expenses, because this is also another factor when you're having these conversations with your advisor about retirement. And as you say, people living for 30 plus years in retirement, you've got to be thinking quite far ahead and thinking about a phase of your life that can seem a long way away.
Yeah.
So what are some of the most common, Luke, I'll come to you for this one, what are some of the most common sort of unexpected expenses that you might have when you're having that conversation with your advisor looking ahead 2-3 decades?
So we always say you should always have an emergency fund of at least 3 months of expenditure in cash, and that should cover expenses. So in terms of people who are at retirement, the things to think about are sort of house maintenance.
Yeah.
Say a boiler breaks down, boilers last normally every 10-15 years, but if that does break down, that could be a big expense, and that's something that you would need to think about in addition to that sort of 23,000 income that you might want every year. So make sure you think about things like house maintenance, any costs associated with family treats, etc., Christmas, birthdays that come once a year. Make sure you try and create an expenditure plan monthly, but also think about those one-off yearly expenses that may or may not happen, and
Yeah.
just plan for any unforeseen expenses, really. Cars breaking down is another one where you might get a nasty bill in terms of a car repair bill. Take it in for its service and MOT and it needs a new engine or something horrendous like that. So yeah, just make sure you plan for these things in addition to your sort of monthly expenses, and it's always good to have that cash fund set aside.
I'm just imagining someone going to the mechanic and you needs a new engine. I think I'll just get a bike if it needs a new engine. It's not just that. It's in retirement. I think Daniel Harrison has said this before. That when you're retired, every day is kind of a weekend. In that respect. So you're doing a lot more leisure stuff. Quite rightly after a lifetime of work. You want to enjoy your retirement. You're absolutely right, Luke. You need that pot there for the boiler and a new car engine and things like this. But you want to enjoy your retirement.
Yeah,
and so
of course.
the amount of money people are going to be spending on holidays, quite rightly, and going away and just frankly taking a bit of pleasure out of retirement. So that's all part of this, isn't it? That's not an unexpected expense, but it's certainly an expense.
It is an expense, and there's always whether it's mentioned or implied, there's an associated cost with retirement.
Yeah.
But the average we talked about in terms of needing £23,000, there's an assumption that goes into that because you would have paid up, your mortgage would have been paid up. So that's £23,000 becomes relevant.
Yeah.
But if you haven't bust all those, if you've not crushed your debts, those high cost debts and mortgages, your car loan and all that, then you're not looking at 23,000 anymore.
No.
You're easily looking at £37,000. So if you want £37,000 per year from your pension pot, you're looking at £1 million easy.
Yeah.
You have to have that in your pension pot.
Wow.
And that's how compounding works. It's always good to stay invested.
Yes.
If you want to have a comfortable or a moderately comfortable life at retirement, now is the time to do it. You plan for it now.
Yes.
So take a broad view of the future, and that's what we're talking about. How do you plan ahead?
Yeah.
In terms of stay invested. Let Kevin and his team do what they do best.
Absolutely.
So if you're using a pension pot as a short term,
Yeah.
dip in, you want to dip into a pension. That's not that's not what a pension is used for. A pension is pretty much a long-term plan.
Correct.
So leave the money there, let it grow, and find ways to boost it as well.
Yeah.
And by putting more money into your pension savings, and all those pensions that you've lost, try and trace them. You can use our pension tracing service in house.
Yes, that's another one you can do, isn't it? To find those lost pensions.
Yes,
That's a good idea, isn't it?
So trace that, get that in, so that once it's consolidated and look and jump on there because they have the the broad spectrum of what you've got.
Yeah.
In terms, and they can pretty much advise you appropriately on what to do with it.
Absolutely. I think it's really worth, we kind of touched on it before, but I think it's worth repeating that if you are in, say, your 40s, now is the time to really have a look at that pension that you might have built up. You may have been in a company pension for a few, 10, 15 years now. You might have moved jobs, as you say, Donald.
Yes,
you might have a few pensions that you've missed. Good time to really get with a financial advisor, have a proper look now, because you've got time to if you need to make adjustments and maybe up your contributions each month and get on a better trajectory, you've got time to do it.
And that's why it's always good to go for financial advice and planning and guidance as well, because what you don't want to do is leave it until you're. It's never too late to start a pension. I'll just say that. So whether you're 16 or 58, you can start a pension, but it's better to start it earlier. And normally we operate a 3-pillar system in the UK. I think we talked about it previously. So you have your state pension, which you cannot rely on. 10,600 is even less than the minimum that you need for the retirement standard. So you have your employer pension, which is the workplace pension, but it's your private pension really that you need to grow in terms of so boost that private pension and make sure that it's a pot that you can use at retirement as well.
Yeah, totally.
So you really want to do that. So full consolidation of your pension pot is what you need, and a financial advisor could actually get you there.
And anybody watching this now who's thinking, right, you've convinced me, I'm maybe in my 40s or approaching 50, I've got a bit of time left in front of me, I need to think about retiring, as in it happening, and I want to speak to an advisor. People can ring us up here, can't they?
Correct.
And
Yeah, you can
speak
ring
to
our phone line.
We've got a whole team of advisors upstairs. People can speak to them.
Yeah, we can get an appointment with an advisor. They can help you. They can look at your pensions, your retirement goals, and we can get that all set up and create that plan.
Yeah.
You mentioned if you're in your 40s, that's going to be if you live to the average life expectancy in the UK, this could be a 40-year investment where you can really benefit for some long-term growth.
Yeah. So as I said again, somebody watching this now or listening to this podcast who perhaps has thought, actually, I've not spoken to an advisor for a few years now. Maybe the last thing I spoke to them about was my mortgage. I really could, do with making sure I'm on the right track. They could ring us up, and within a very short space of time, by the end of the day, they could have a plan set up and the information they need, and it could be as simple as that, couldn't it?
Correct. Yeah.
Great. All right. Good. Okay. So we've talked about are you financially ready to retire? Looking at where you are. We've talked about those unexpected expenses. Another thing we want to mention is another tip, if you like, is to eliminate the big expenses. Now, give us an example of what some of those big expenses could be.
So the obvious one everyone's mind will be the mortgage. Obviously,
Yeah.
to get close to retirement, you want to make sure that's paid down as much as possible, if at all completely repaid. If you look at mortgage interest rates and what's happened recently, I think the average mortgage rate now is near 5%. So it's going to be an expensive debt. If you have personal loans, likewise, they're going to be negatively affected by the interest rate rises. So just try and make sure that as much debt is repaid. The big one is going to be the mortgage, or any car loans, personal loans, etc.
Yeah.
Credit cards, make sure they're repaid before retirement.
Yeah, and that's where you could dip in and take a bit of that lump sum, tax free, take that out, clear some of that debt, leave the rest invested, and you've ticked both boxes.
And that's correct. And we'd always say the most expensive purchase you ever make in your lifetime is your mortgage. So you own your home.
I think children come a close second to that.
Well, children, but throw another curve into that. That's when you're looking at the net present value of the purchase. Well, children, when you borrow to children, but if you're looking at the net present value over time, i.e. retirement being in time, the most expensive purchase could be retirement.
Yeah.
Because you are living 30, 40 years easy. All the thing is, you want the full package, full financial advice. Don't lose sight of your assets. What are my assets now? In terms of, those are the assets, those are the things that gives you the positives.
Yeah.
But don't lose sight of your liabilities as well at retirement. What would my liability be when I've retired? Do I want a minimum lifestyle?
That's right.
A moderate, a comfortable lifestyle. So what do I need to put into a pension now to give me that kind of lifestyle that I want? If I want a minimum, you're looking at £320,000 pot for the minimum. If you want a moderate, you're looking at $500,000, we've talked about, to £600,000. If you want to be comfortable, $1 million. So those are the things. So, and those planning processes come now.
That's right.
Not when you're 65 or 68.
On the point about kids, I mean, I don't want to eliminate my kids, but I wouldn't mind eliminating some of the costs that they might have on me in a few years' time. So one way I could do that is, to this point about planning, if you're in your 40s, you might think, well, actually, if I open up, say, a junior ISA and start putting some money aside for them now, by the time they become of age and I'm becoming towards retirement, maybe they've got their little pot to fund their I don't know, university fees or a deposit for a house. Because otherwise, what I imagine would happen is they're on the phone saying, "Listen, mum, dad, can I just come and raid the bank of mum and dad for a few quid?" And again, that could be an unexpected expense. It could be a chunky expense to this point. So, is one option you could do is to, again, when you're a bit younger and you maybe get a bonus from work or whatever, or just we've talked about out of your pay packet, treating it like a direct debit. Put a few quid into a junior ISA and build that for them over the long term.
Just like
as well.
you can have a stocks and shares ISA for yourself, you can put a ISA in your child's name, and they can have access to that when they're 18. So that's again, if you start when they're young, that's a 10-year plus investment time frame where you can really again benefit from some long-term investment growth. You can do a direct debit basis, so you can take it from your pay every month.
Yes,
and it's just about putting that money aside. So for my daughter, who's nearly 2, we've started putting a little bit of money aside because we know that university costs, etc., will be expensive when they get older. So that's a really good way of doing it, and just adding that to your sort of monthly expenses.
And it's a brilliant way of saving for children as well, because the incentives you get for pension, children also get it as well. So for every 100 you put in a pension account, into a pension account for a child, the child gets £20 from there for every 100 as well. Right up to 3,600 as well. So which is
and you can do that. You can open a pension for a child as well.
You can open for as soon as they're born in the hospital and you're going home. You can open a
pension.
So from 1 day old, you can open a pension and still get the benefits of a pension as well. And that's what a lot of people don't know. And that's what we.
I didn't know that.
So you can do that. I've got my daughter is 7 years old, and I opened a pension for her a week after she was born. So it's a brilliant way of getting money, the intergenerational wealth as well. Yes, you're building your pension pot.
Yes,
it's also good to build their own pension pots as well.
Can you get them a bus pass as well at that age as well?
I wish you could, but they do get free bus passes, I think.
There you go. See,
it's expensive.
Well, that's fantastic. So you could do that, and the beauty of that is, of course, if you're opening up a pension for your child, when they're born. I mean, they've got decades and decades and decades. So there's small amounts over the years through the kind of growth and then the compounding that Kevin and his team can generate. You don't need to put huge sums away because that's got decades to grow, hasn't it? So really, just little bits could become vast sums by the time they... And then, of course, by the time your kids are retirement age, they won't have to worry about any of this because you'll have started them off so young.
And children are in their formative years as well when they grow and they learn stuff. So that's the time you really, really want to teach a child how to save and how to invest as well. Because by the time because if you leave it till you're in university and all that, and you need your money for something else. So teach them young in terms of how to save, and you pretty much will keep them for life. At a part of the industry at TPI also and True Potential as well, we're looking at that to see how we can actually teach children how to save.
This is brilliant.
From their formative years as well. Because by the time they're 18, 16, 18, I mean, it's difficult to change a habit. But once you get it right, I mean, just as, we don't want to eat our greens. And that's because you've not been feeding them greens when they were 1, 2 years old.
This is true.
So let's get them into that pension when they.
I think it's a great point. Fantastic. I, to be honest, I know about junior ISA. I didn't know you could do that. So I'm gonna have to get onto that. Have you got a pension for your 2-year-old set up?
Not yet. No, he did well to do it a week after she was born. I think I was asleep.
I mean, I had to practice what I preach.
You were on the ball there, but weren't you? Like say, And how old? So you're 2. Is it boy or girl? What's her name?
Ola.
So when Ola's in the playground in a few years' time, and her friends saying, "What have you done with your pocket money this week?" She'll say, "I popped it into my pension." There you go. Brilliant. I think it's fantastic. This is great. Well, there you go. We've learned something new. We've talked around the 25% tax-free lump sum. We touched on that a little bit earlier on. But I just think it's worth coming back to this point around investments and. From a client's point of view, I mean, on the one hand, we trust you and your team, Kevin, because you're experts at what you do. You've generated fantastic growth in the portfolios. As I always say, people can pick a copy of True Insight and you can see the performance figures in there over the long term. Absolutely brilliant. But so we don't almost like we're happy to trust you and let you get on with it. But it's worth understanding your investments, isn't it? And understanding what you've got and what you could get and the risk profile you're in and all this. So tell us a bit about what you do day to day and how you generate those returns for us.
So every month, True Potential speaks with the managers who are part of the asset allocation. So we think about it, there are about 8 managers, say, for a balanced risk profile who manage.
And there'd be people like who? UBS?
So you would have UBS, you have Goldman Sachs, SCI in America. So these are genuine like blue chip names.
World class.
Yep, and True Potential is a very important client for them, and Chris Leyland and his team enjoy a very strong relationship, very respectful relationship with these investors. So every month, understand from these investors what their outlook on the market is and what changes they've made to their portfolio, and then that actually feeds into a process that Chris leads where, and it started yesterday for the month of May, where we as a team review our outlook compared with the manager's outlook. Where do we think the best opportunities are, and Chris and his team will then make a few changes to the portfolios to best capitalise on valuations, etc. So, and that comes through in, say, the Insight magazine in terms of pie charts of where the money's allocated globally, how much of it is in equities versus fixed income, and how much.
But it's all in the app 24/7 anyway,
exactly.
so you can have a look in the app whenever
a variety of media available for
Yeah.
clients to see where the investments are.
Yeah.
And I think it just, the more you know about your investments at a high level, I think it can just help prepare you for those little bumps along the way.
Yeah.
But in a market cycle which typically trends up over time, and again, this is a point Sir David makes, which is staying invested, the compound effect, it does trend up.
Yeah.
And we had a really big shock last year, and that seems to be behind us now with markets up year on year. So it does, being informed and staying invested, and if you can incrementally add, it all adds up.
Yeah, and understanding your investments from the point of view, as we said earlier, about looking at the app, seeing whether you're on track. So if you're not on track, making those adjustments, which are really easy to do. You do it in seconds through Impulse Save. So if you need to, if another 25 or £75 will get you back on track, you can make that adjustment in seconds. But you've got to be able, having access to your investments
and if you're
understanding them is key.
And obviously, if you're after, if a client's after a bit more information, the Morning Markets podcast, early every morning, does help give you that sort of summary on something that you may want more information on, and you can always follow up with your advisor, of course. So everything's available.
I always think it's worth saying, you and your team and True Potential more broadly, we manage about £25 billion worth of people's pensions across the UK. So that's a lot of money. A lot of people's pensions are with us. That's a vindication. That's an element of trust. 1 in 5 financial advisors in the UK works with us. Will bring their clients towards us. Will use our services. So again, we're a big. A big firm. We know what we're doing. We are. I always say, Kevin, your team are the experts, and I mean that genuinely. But people like Donald and Luke as well. So there's a lot of trust in this company out there. So you're in safe hands with us. We've talked about the lump sum. I wanted to touch on inheritance, because this is another big important factor when it comes to pensions. Tell us about pensions and inheritance tax. What the rules are, Donald.
Thanks. The pensions, anything saved within your pension in the pension wrapper is actually out of your estate, a client's estate. So what that means is it's not taxed within the estate if a client dies. So any contributions you've made or transfers into a pension, and let's say a client dies, it's not the inheritance tax would not be taken away from that pot. That's why it's good to actually put money into a pension. And anything within that covering is also safe as well. And that's where the concept of the EET comes in as well. So exempt when money goes into your pension, you're exempt with any investment at all that you make. You're only taxed when it comes out. So within that covering, but it's always also to reiterate to go for every pension you have, it's always good to get an expression of wish in place as well. So that's just an expression to go. How do you want your pension to be dispersed?
Where do you want it to go?
Where do you want it to go when you die? So always it's out with your estate, but you still want to have a bit of control where it goes when you die. So it's always good to actually make sure that all the money you put in your pension is actually safe, and you're not, and you do it earlier as well. So the more you put into your pension, the more is out of your estate, and it's not taxed at all.
Are there any age restrictions or thresholds that kick in to do with the age if you're passing a pension on? Does that apply? Or?
Not in terms of inheritance tax. Obviously, pensions are tax free if you on death under age 75. Over age 75, if your beneficiary will pay income tax on the pension that they've received.
At their rate, at their kind of marginal rate.
They're in their rate. So if they're basic rate taxpayers, they'll pay basic rate up to the rest of the basic rate. So in terms of inheritance tax, it's a really good point. Look, the main residence nil rate band is £1 million for a married couple with children.
That's correct.
If you have a house in London, then you could have a property that's worth there or thereabouts if you bought that early on. So for a lot of people, they might have breached that inheritance tax threshold when they're at retirement. They might not know. You can invest in a pension that can remain invested. You can pass that on in a tax efficient way to your children or your beneficiaries, and then they can leave that in a pension as well, and it can remain invested. So we talked about a 40-year investment time frame at retirement, but actually this pension could be more than that. It could be 100 years once you pass it on to your children, etc. So a really long period of time where it's invested, it can benefit from growth, but it's also outside of your estate for inheritance tax as well.
And in terms of beneficiaries and things like this, who you want your pension to go to, you can do that through the app. You can go in and
Correct.
you can name somebody in the app.
Let us know who you want to
Is
do.
it? Can you do more than one person if you want
Yes,
to?
you can split the pension. You can say I want X% to go to him or her,
Yeah.
and then X% to go to someone else. You can split it.
Right.
You can do whatever you want. It's a very flexible way of passing on your wealth.
So you could do sort of a certain percentage to say your spouse, and then name a child as
Children.
well. So it could pass
Correct.
through the generations if something happened, and on it
Yes, of
goes.
course.
Brilliant.
What you want to do is just make sure the total is 100%.
Yes.
So it's clear,
Yes.
insights for trustees too, so that they know exactly how they need to.
How
So
it
what
needs
you,
to go.
exactly. So 50% to your child, 50% to your daughter, if that's what you want, or split it however way you want. So yes, and you can do it over the app as well, or go to the website to do it as well.
Yeah.
If you want to call us as well, you need a form. We still got that as well. We can do that as well.
Well, I
So
think it's been really enlightening, and
it's,
I think, as I say, I said it halfway through that I think the best thing you can do really today is on the back of this. I mean, is give us a call, speak to Luke and the team, and they're all here, and they'll take your call. Or you can set an appointment and just go through this stuff, and within a short space of time, within half an hour, or maybe a bit longer, you could have all this sorted and be in a much better position. So do think about doing that. Pick up the phone and have a chat with us. We'll we'd love to talk to you. Excellent. Look, I think we've covered off those six of the best, the 6 things we said we wanted to know before you retire. So are you financially ready? That's worth a consideration. Have you planned for unexpected expenses? Have you eliminated the big expenses? We talked about understanding your investments, your 25% tax-free lump sum. You don't have to take it, but there are things that Kevin mentioned that you could do with that, and of course keeping your money invested for inheritance tax purposes, and some of the rules around that. So there's our 6. I'm going to come to each of you and say, Have you got a favourite of those, or even maybe a bonus one? Have you got an end of week podcast bonus, Donald, or which one particularly took your fancy the most?
Well, for me, it's pretty much just boost my income, boost my retirement and study now. So I want to picture my future.
Yeah.
What do I have now? What do I need to do to put into that pension?
Yes.
And just go for it, boost it, put as much as I want. So that's for me. That's what I would really. That's what stands out for me. Mm-hmm. So the more money, I want to be comfortable in retirement.
Yes.
When I retire,
Yeah.
so I'm looking about 55,000 because I'm married. So that's 55,000 per year so 55,000 per year. So I'm effectively looking at a 1.7 million pot. So I need to start it from now.
Yes.
So every little helps. Every little in the pension helps. Every little in that pension counts. So I'm starting it from now. So that's just it. So, and that's the encouragement that we also give to our clients and our clients as well. The more money you put in your pension, it can only be better for you at retirement.
Yeah.
So
absolutely.
do it now.
Good advice. Good tip.
No surprise from an investor. I would say take time to understand your investments, and you can use the app to watch the videos, and that just gives you. It's only 3 minutes a day.
Mm-hmm.
You can don't have to watch it. You can listen to it, but you can get those little nuggets of truth about markets, and it just helps guide you along the way with your investments.
Yeah, good plug. That's morning markets every morning. Normally it's out 9:30, 10 o'clock. Certainly, by 10 o'clock.
Yep.
As you say, 2 or 3 minutes long, and it's just everything that's gone on in the markets. So
And we show on screen what markets have done.
Yeah.
Which complements what's in the app.
Yeah.
So it's all there for you.
Yeah.
Plenty
And you
of
can get that
information.
on this channel, as you say, in the app.
Yep.
So it's all there. Come on then, Luke.
All really good points, Peter, but if I had to pick one, I would say the tax-free lump sum with a personal pension. Now, historically, people always took their tax-free lump sum straight away. A lot of people don't realise that now. You can take it out in phases, you can make it more efficient, you can use it to provide your income. So I would say look at that and look at potentially not taking all your tax-free cash at once for the reasons we've mentioned there.
Excellent. Correct. I think my favourite's go and set up a pension for your child.
Yes,
I'm going to go and do that today, Don. Lads. See, there
great.
you go. I'm going to go and take your tip, take your advice. I'm going to speak to you afterwards and get a couple of pensions.
Be the coolest kid on the playground with the pensions.
That's right, yeah. Cruising with a Lamborghini when they're 18 years old.
Absolutely, that's
Can't,
what we
can't
want.
access your pension legally, so that doesn't work. At least I'll have
I'm talking about my
55.
My mother always say that.
cruising to a playground at 55 with a Lamborghini.
Yeah, I mean, she
Coolest
would
dad
always
in
say
town.
that the tragedy is not, the tragedy at old age is not dying.
Yeah.
I'm like, so what does that mean, Mom? You're like, well, The real tragedy, financially speaking,
Yeah.
is dying without a pension pot.
Yeah.
That's, I mean, I was 25 when I got it. Because she was always saying, oh, what does that mean? What is it? But
Yeah.
that's essentially what that means is
Yeah.
you need to be financially secured in a way, and the only way you can do that is put money into your pension.
Yeah. So no, you took that on board, didn't you? And it's obviously
It stopped.
stayed with you. Yeah. Did you eat your greens as well, Donald? You mentioned that.
No, I didn't.
You didn't. Oh. Well.
What, come on now. Look at the height.
We've got some greenery in front of you.
Well, if I
Try and
hit,
stand if you
the
want.
greens, I'll probably be taller. That's what I did.
Excellent. All right. Before we get into any other carry on, let's draw to a close there. But I think that's been really useful. This is exactly what we try and do on the True Potential podcast. Just try and give you little things and bits of advice like this, or bits of tips like this, which are perhaps things you may know some of them, you might not know others. But if we've learned something new today, then we've done our bit, and I certainly have learned something new. So thanks very much to Donald, to Kevin, and to Luke as well. Thank you also for tuning in again this week. We appreciate that, we really do, and we love it when you give us a like and a subscribe as well. So if you can just spare us a few seconds to do that, we'll love you forever. And until next week, thanks for watching. Bye for now.